Welcome to the Research Desk.
We are examining what I consider to be a fundamental market mispricing concerning the communication stream of the Trump administration.
Precisely. Imagine the reality facing a portfolio manager on any given Tuesday morning. The baseline environment is, frankly, overwhelming and seemingly intractable.
You are looking at an average of 10 distinct policy announcements crossing the terminal in a single day. 10 distinct rhetorical threats or diplomatic postures.
And of those 10, historical data suggests that approximately 6 will be subsequently softened. They will be delayed by administrative friction or just outright contradicted by another official within a 72-hour window.
Which leads to the prevailing institutional reflex. The default setting for most trading desks is to simply treat this sheer volume as pure noise. They categorize it as a theatrical distraction, a chaotic byproduct of a specific personality.
And therefore, an anomaly to be faded. But I argue that this fundamental assumption systematically destroys capital. The communication stream is not pure chaos.
I have to push back hard on that premise right out of the gate. Any signal extraction model applied to the specific administration is a dangerous delusion. You cannot quantify a system that is expressly designed to deny order.
It contains highly investable, quantifiable regularities, provided you apply the correct institutional and linguistic filters. There is a durable directional drift beneath the daily volatility. Markets consistently fail here because they overreact to the literal wording of a given headline while drastically underpricing the structural vector beneath it.
But ambiguity is not a byproduct of a messy communication strategy. Ambiguity is the policy itself. Attempting to find a stable base rate in a highly adaptive, deliberately contradictory communication stream will only lead to capital being violently whipsawed.
We are not merely talking about intraday headline volatility here.
Exactly. If persistent uncertainty is a regime feature, it fundamentally alters supply chain architecture. It alters long-term capital expenditure planning, and most importantly, the discount rate applied to future cash flows. Look at the behavior of the United States dollar to euro pair in early 2025.
The markets were already pricing in the rhetoric.
They were adjusting risk premia and altering cross-border capital flows long before any actual policy was drafted, let alone formalized. The threat itself alters the baseline reality. Treating that dynamic as a neat, filterable dataset completely misinterprets the strategic utility of the chaos.
I disagree with the characterization of it as unfilterable chaos. We must draw a strict line between the vector and the daily tape. In physics, a vector has both direction and magnitude, regardless of the turbulent air currents around it.
But the daily language contradicts itself within a 48-hour window. A threat is issued on Monday, walked back by a cabinet secretary on Tuesday, and then restated with entirely different parameters on Wednesday.
It is entirely true that the tape is erratic, but look at the underlying vector over a multi-year horizon: structural protectionism, tariff leverage as a primary diplomatic tool, the aggressive weaponization of the dollar, and domestic deregulation. That vector remains remarkably stable across entire economic cycles.
Investors struggle profoundly because they demand traditional policy guidance.
They want white papers, they want carefully curated press releases, and predictable interagency consensus. When they do not receive that specific format, they just dismiss the entire stream as unanalyzable. But we have the tools to quantify this noise.
You are talking about the integration of behavioral economics and computational linguistics.
Yes. It offers a highly precise methodology for converting rhetoric into tradable probabilities. We do not need to play parlor games, guessing the administration's inner intent. We only need to measure the intensity and consistency of the language used over time. So what actually happened? Think about this for a second.
Let us look at the actual data rather than the narrative.
In the first quarter of 2016, the communication baseline showed a lexical aggression score of 35.
And just to clarify, for the baseline, this score is generated by natural language processing algorithms. They evaluate the frequency of combative verbs, the use of absolute adjectives, and the proximity of threats to specific geopolitical actors.
Correct. During that same period, the thematic consistency around terms like tariffs and unfair trade sat at partially 30%. The rhetoric was present, but it was scattered.
And what was the policy outcome?
No major tariffs followed that period.
The rhetoric did not possess the density required to become policy, but look at the first quarter of 2018. The lexical aggression score spiked to 78. That is a massive, quantifiable regime shift in the data.
Furthermore, the thematic consistency surrounding those exact same trade terms hit 92%.
I want to let those numbers sit for a moment. 35 jumping to 78, 30% consistency jumping to 92.
Repetition, combined with specificity, consistently beats literal headline reading.
The algorithm does not care if a single tweet is grammatically perfect or if it contradicts a statement from the previous week. It measures the mass and the velocity of the language.
But how do you actually structure that into an asset allocation model? We can structure this through a definitive 3-layer institutional filter. Layer 1 encompasses the daily statements, social media drops, impromptu rally rhetoric, press gaggles on the White House lawn. Our data indicates this layer is roughly 80% noise on an hours to days horizon.
If you trade that layer, you will be destroyed by the transaction costs and the reversals.
Absolutely. Layer 2 involves concrete administrative movements, executive orders, Federal Register actions, notice and comment initiations, and specific cabinet-level appointments. This layer becomes 70% signal on a months to quarters horizon.
And layer 3.
Layer 3 represents the structural policy and the established tariff architecture. That operates as 90% signal on a multi-year horizon. If you align your capital with the correct layer, the theater is no longer a distraction. It becomes an entirely tradable roadmap.
I find applying an elegant 3-layer probability matrix to a negotiating style that actively punishes predictable models to be fundamentally flawed.
How so? The data clearly shows a correlation.
Let us unpack how these natural language processing models actually function. They rely on historical correlation. The lexical aggression score of 78 might correlate perfectly with an outcome in 2018, but that completely assumes the conversion rate from threat to implementation is fixed across time.
You are suggesting the conversion rate changes?
It is absolutely not fixed. The communication stream we are discussing is inherently aggressively adaptive. Once a quantitative model learns a specific pattern, once the market decides that a lexical aggression score of 75 means an 80% probability of a tariff, the administration shifts tactics.
But the structural vector remains the same?
The speech is not designed to be forward guidance for your 3-layer filter. It does not exist to help markets price assets efficiently. It functions primarily as pressure.
Pressure that inevitably leads to policy implementation.
Or pressure deployed to mobilize domestic political bases, to distract the press corps from other vulnerabilities, to test the resolve of geopolitical adversaries, and to shift negotiating baselines without ever needing to resolve into coherent legal text.
I think you are underestimating the real-world impact of that pressure.
Applying a quantitative model to this communication style is like trying to map the flow of a river while someone is actively dynamiting the dam. The administration does not just change the message, they change the topography of the market itself.
That perspective assumes that the real-world economic actors, the corporations, the supply chain managers, the capital allocators, wait passively for the dam to be rebuilt. They do not.
They are forced to react, yes, but reacting does not mean they are reacting predictably.
The framework does not require the rhetoric to resolve into legal text immediately to be highly investable. This brings us to the core mechanism of how this regime actually operates on the ground. Soros-style reflexivity.
Reflexivity, the concept that the participants' biased perceptions actually change the underlying fundamentals of the system.
Exactly, which in turn changes the perceptions. It is a feedback loop. The traditional market view assumes a linear progression. A policy is debated, it is drafted, it is signed into law, and only then does it impact the real economy.
And you're arguing that linear model is entirely obsolete under this administration?
When an administration utilizes aggressive, highly thematic threats, the threat itself reshapes capital expenditure plans. It reshapes inventory accumulation and supplier contracts before the legal drafting even begins.
A statement that initiates as pure uncertainty transforms into economic reality
simply because a critical mass of corporate actors must prepare for it.
The rhetoric bypasses the legislative process, bypasses the traditional bureaucratic friction, and instantly becomes the operating environment. Consider the specific, documented example of BMW in 2018.
Let us walk into that corporate boardroom.
The administration was escalating its trade threats against European auto manufacturers. There was no finalized universal tariff regime in place. There was no clear statutory authority being invoked at that exact moment.
The daily tape was entirely erratic.
Yet, in the midst of that chaos, BMW committed $600 million to expand their United States production capacity at the Spartanburg, South Carolina plant.
A corporate board does not authorize a $600 million capital expenditure, a multi-decade commitment of physical infrastructure based on an assumption of pure noise.
They do not spend that kind of shareholder capital on a whim. They allocated that capital in response to the rising probability of implementation. By the time absolute policy certainty arrives, the real economy is already moved.
So you are saying ignoring these signals is akin to ignoring historical precedents.
Ignoring them is akin to ignoring the rhetoric leading up to the Smoot-Hawley Tariff Act of 1930. The legislative process for Smoot-Hawley was chaotic. It was filled with log rolling and contradictory amendments.
It started as a narrow agricultural protection bill and ballooned into thousands of tariff hikes.
If an investor in 1929 waited for the final bill to be signed, they were already ruined. The market crashed as the structural vector became obvious through the rhetoric. Or consider the geopolitical and economic signals before Nixon's 1971 shock that abruptly ended the Bretton Woods system.
Nixon closed the gold window in August.
But the rhetorical attacks on currency speculators and the complaints about unfair exchange rates had been building for months. The warning signs of a structural protectionist shift are always rhetorical before they are statutory. If you wait for the Federal Register to print the final rule, your capital is dead money. You've missed the alpha.
The BMW Spartanburg expansion is a classic survival bias narrative. You're looking at the corporation that successfully navigated the chaos and using it to validate the model.
It is a clear example of reflexivity in action.
But for every company that successfully preempted a policy shift, there is a counterexample of a corporation that was entirely destroyed by attempting to react rationally to the noise. You mentioned reflexivity, the idea that the threat creates the reality, but you completely ignore the strategic utility of the chaos itself.
The chaos is simply the outer layer of the vector.
The administration utilizes a 145% tariff threat on China. The market panics. Supply chain managers scramble to find alternatives in Vietnam or Mexico, incurring massive transition costs. Then, the administration follows it with a sudden pause, citing a breakthrough in negotiations.
Which is layer 1 noise.
The tariff is delayed. Then, 3 weeks later, just as supply chains begin to adjust back, the rhetoric re-escalates. That sequence is not an analytical inconvenience that your natural language processing model can smooth over with a rolling average. That is the defining feature of the negotiating method.
It is leverage.
It is designed to extract maximum leverage by maximizing dislocation. You cannot build a sturdy table if the blueprint changes mid-build. Let us look at the reality of how this punishes rational behavior. Look at the Harley-Davidson trap.
Harley-Davidson was caught in a unique crossfire.
Harley-Davidson attempted to behave exactly as your institutional framework suggests. They analyzed the rising probability of the European tariff regime, which was a direct retaliatory response to the United States' actions. They looked at the math.
Absorbing a 31% European tariff would collapse their profit margins.
And raising prices would destroy their market share in Europe. So they made the completely rational, model-driven corporate decision to shift a portion of their production overseas to Thailand to mitigate those costs and avoid the crossfire.
A rational response to Layer 3 policy implementation by the EU.
And what happened? The immediate domestic political backlash trapped them. They were attacked ferociously on social media and in press briefings by the very administration that initiated the trade friction.
They became a political target.
They were caught in an impossible triangle between policy uncertainty, international retaliatory logic, and intense domestic signaling. The noise itself altered their operating environment so violently that it punished their proactive behavior.
But the underlying tariffs still materialized.
The communication stream punishes hyperactivity just as severely as it punishes complacency. This is why I argue your filtering creates false confidence. You assume that identifying the vector protects you, but when ambiguity is the policy, taking early action based on an algorithm makes you a highly visible target.
It makes you a target, but it protects your margins over a multi-year horizon.
This leads us to the true bottleneck that algorithms, lexical aggression scores, and quantitative models completely fail to parse: the profound friction of state capacity.
State capacity is exactly what Layer 2 of the filter measures.
Let us use a 19th century analogy. This administration practices modern gunboat diplomacy. In the 19th century, a naval power did not necessarily need to bombard a port. Simply parking the fleet on the horizon altered the terms of trade.
A highly effective strategy.
In August 2019, an official statement was released declaring that American companies were ordered to immediately look for alternatives to China. The market violently sold off. Operationally, functionally, and legally, that statement was deeply dubious.
It lacked an immediate statutory mechanism.
The president does not have a dial on his desk to simply unplug the American economy from the Chinese manufacturing base. But the cannon did not need to fire. The mere presence of the fleet on the horizon forced immense orbit contingency planning.
Which again proves reflexivity.
However, the market routinely misprices the massive gap between presidential desire and administrative deliverability. Can that order actually be implemented? It would require invoking the International Emergency Economic Powers Act,
which requires declaring a national emergency.
That requires extensive agency rulemaking under the Administrative Procedure Act, which mandates notice and comment periods. That inevitably leads to immediate federal court review and likely injunctions.
But the vector remains intact.
A threat routed formally through the United States Trade Representative is fundamentally different from an improvisational statement made at a rally. Algorithms read the noun tariff. They read the verb ordered. They do not read the bureaucratic friction, the legal hurdles, and the institutional resistance required to enforce it.
The friction of state capacity is not a flaw in the analysis. It is precisely what separates the noise from the signal. The bureaucratic friction is exactly what the three-layer filter is designed to measure.
Measuring friction does not eliminate the fact that the friction delays the implementation.
This brings us to the single most critical sequence of this entire era. The sequence that proves why the structural vector is tradable. In early 2018, the prevailing market assumption was identical to the bearish case you are outlining right now.
Institutional investors, high-frequency desks, macro hedge funds, they all believed the statements were purely venting.
They believed the threats lacked administrative deliverability. They assumed the tweets were just noise to be faded, relying on the exact bureaucratic friction you just described to save the status quo. On March 1, 2018, the statement dropped, "Trade wars are good and easy to win."
The broader market largely shrugged it off.
It was categorized by almost every major desk as rhetorical access. It was viewed as another example of the gunboat diplomacy you described, meant to posture for domestic audiences rather than execute actual policy.
The consensus was that the institutional friction would prevent anything binding from materializing.
On March 8, 2018, the reversal hit. The administration formally imposed 25% tariffs on steel and 10% tariffs on aluminum.
That was a definitive shock to the system.
Consider the timeline. 1 week, 7 days from a tweet that the market dismissed as noise to the formal execution of a multi-billion-dollar tax on global supply chains. The point is not to decode hidden rationality. It is to recognize that some channels are inherently more binding than others.
The 1-week timeline from an improvised tweet to a multi-billion-dollar structural shift in global trade architecture shattered the baseline assumptions of every major trading desk. How did it happen so fast?
Because the market was looking at the tape, not the vector. The market missed the fact that the Commerce Department had been running a Section 232 national security investigation into steel and aluminum for months prior.
The administrative pipe was already pressurized.
The Edge was never predicting what would be said next. It was pricing how much of the theater would survive contact with the state. The steel and aluminum tariffs survived because they had thematic buildup, they had intense agency alignment under the Commerce Department, and they had a viable legal pathway through Section 232.
The market priced the first sentence on social media and completely ignored the administrative chain that was already moving in the background.
That is why the filter works.
I acknowledge the March 2018 sequence as the definitive proof of concept for the structural layer. I concede that point. When rhetoric perfectly aligns with the institutional machinery of the Commerce Department and the United States Trade Representative, the conversion from theater to policy is blindingly fast.
It catches the market off guard precisely because the market assumes bureaucratic delay.
But recognizing that historical sequence does not solve the forward-looking portfolio construction problem. If the true edge is institutional, cross-sectional, and probabilistic, we must define the exact mechanisms for capital allocation.
We cannot simply operate on historical analogies about Smoot-Hawley or postmortems of 2018.
If we accept that there is a tradable signal beneath the noise, we must apply rigid, specific, unforgiving rules to navigate the gap between presidential intent and administrative execution. How do you actually deploy capital in a regime where the dam is constantly being dynamited?
We deploy capital by stripping out the emotion and applying a strict 5-question institutional filter before making any portfolio adjustment. This is the exact mechanism. Question 1, has the theme repeated across weeks rather than hours?
We are looking for density of language over a sustained period.
Question 2, does the rhetoric match prior established governing priorities? A thread about trade aligns with the vector. A random thread about a specific domestic media company often does not.
Question 3. Are the relevant agencies, such as the United States Trade Representative or the Treasury Department, aligned with the statements? Is their background paperwork moving?
Question 4. Are the affected sectors or companies named specifically, moving the threat from macro to micro? And question 5. What is the historical implementation rate for that exact category of threat?
If fewer than 3 of these questions return a definitive yes, the statement is categorized immediately as Layer 1 noise. The desk ignores it. No trades are executed.
However, when the filter indicates signal, when the administrative alignment is present, the portfolio mechanics are absolute. There is no hedging the execution. We maintain a strict 7% overweight to United States domestic manufacturing and infrastructure.
The specific instruments deployed for this are the Industrial Select Sector SPDR Fund, ticker XLI, to capture the broad reshoring trend, and the Global ex-US Infrastructure Development ETF, ticker PAVE, to capture the domestic capital expenditure cycle.
The rule here is rigid. We only reduce this to market weight if the America First policy consistency measured by the linguistic models weakens materially for 3 consecutive months. For tactical tariff beneficiaries, we deploy a 3% allocation to domestic steel and aluminum.
The specific equities are United States Steel, ticker X, and Alcoa, ticker AA.
The exit rule is equally precise. We do not hold these on sentiment. We exit the position entirely if trade-related lexical aggression falls below 60 for 2 consecutive weeks. If the temperature drops, the capital moves out.
On the short side of the ledger, we maintain a 5% to 10% underweight in globally exposed supply chains. This specifically targets semiconductors and automotive manufacturing.
These are the sectors most highly vulnerable to cross-border friction, unexpected export controls, and retaliatory tariffs. We absolutely do not use blunt index downside protection.
Buying broad index puts is a waste of capital in this regime because the broad market beta may remain incredibly resilient. The S&P 500 can grind higher even during a trade war.
Instead, we allocate 7% to short-term volatility instruments, utilizing VIX futures or inverse ETFs, focusing our hedges explicitly on sector dispersion. The internals of the market rotate violently under this regime. One sector surges on a tariff, another collapses on retaliation.
Finally, for uncertainty hedges, we do not rely solely on fiat currencies. We overweight physical gold by 7% using the SPDR gold shares, ticker GLD.
Alongside that, we allocate 5% to geographically diversified cybersecurity leaders, specifically CrowdStrike, ticker CRWD, and Zscaler, ticker ZS. This captures the non-discretionary, mandatory corporate demand inherent in geopolitical fragmentation over a 12 to 18-month horizon.
No matter what the rhetoric is, corporate boards must spend on cybersecurity when the geopolitical vector fractures.
We converge on a shared understanding that treating this communication stream as pure entertainment, or conversely, Reacting to it as direct, literal policy guidance will systematically destroy capital.
The true edge is not psychological analysis of the speaker. It is institutional, cross-sectional, and relentlessly probabilistic. It requires an incredibly disciplined assessment of the friction between the rhetoric and the state apparatus. But as we map these exact allocations and rely on historical precedents like March 2018, this leaves us with a critical, unresolved dynamic as we look forward.
The speed of execution.
When the market fully adapts to pricing the administrative friction rather than the rhetoric, what happens to the underlying assets when the state apparatus actually speeds up? This is the research desk officially signing off.